Okay, let's unpack this. Today, we are looking at something that, well, at first glance, it might seem like it belongs strictly on the desk of some corporate accountant who's just buried under a mountain of spreadsheets.
Right, it definitely had that reputation.
Yeah, totally. We have this massive stack of sources in front of us today, and they are all drawn from a highly technical, incredibly dense CA final textbook. Specifically, it's Advanced Auditing, Assurance, and Professional Ethics.
A light weekend read.
Oh, yeah, real page turner. But look, I know exactly what you might be thinking right now. You might be prepping for a massive board meeting or trying to catch up on financial compliance.
Or maybe you're just insanely curious about how the global financial world actually verifies its truth.
Exactly. But if the mere word auditing makes your eyes glaze over, I really need you to stick with me. Because today's mission is entirely different than just reading a textbook.
It is indeed. We are taking a document designed for high-level professional examinations and, well, extracting the core frameworks.
Mm.
What's fascinating here is that auditing is not just about numbers on a spreadsheet or ticking boxes with a red pen.
Right.
At its absolute core, auditing is the ultimate framework for finding truth in a world of incredibly complex and often intentionally manipulated data.
Manipulated data, yeah. That's the real world.
Exactly. These frameworks, the systematic ways auditors break down risk, evaluate evidence, and hunt for deception, they can be applied to evaluate risks in your own business, your personal projects, or even how you process the endless stream of information in your daily life.
I love looking at it through that lens because here is the specific challenge we are tackling today. This source material is heavily reliant on lists.
Endlessly.
Yeah, endless, highly technical, deeply nested lists of principles and assertions and components. It is exactly the kind of material that is notorious for slipping right out of your memory the second you stop reading.
It's cognitive overload.
Exactly. So our goal today isn't just to help you passively understand these complex auditing concepts. Our mission is to permanently wire them into your brain.
I like the sound of that.
Because the stuff is so list heavy, whenever we hit a wall of dense criteria, we're going to stop, break it down, and build custom memory techniques and mnemonics. We are going to build bizarre, unforgettable mental images so that by the time we're done, you won't just know how an auditor thinks.
You'll be able to rattle off their core frameworks without skipping a beat.
Exactly.
It is a highly practical application of cognitive science, actually. Human memory fundamentally struggles with abstract lists of technical jargon.
Oh, I know mine does.
But it clings tightly to narrative, absurdity, and structured imagery. By pairing the rigorous logic of these international auditing standards with vivid memory hacks, we can completely bypass the typical rote memorization process that students usually suffer through. We're going to anchor these concepts to things you already know.
So, whether you are managing a team, evaluating a massive personal investment, trying to figure out if a company you want to work for is built on a house of cards, or just, want to know how the corporate world catches or spectacularly fails to catch massive financial fraud, this deep dive is for you.
It's highly relevant.
Right. Let's start right at the absolute foundation. We need to talk about what I like to call the equation of disaster.
I like that term. In the auditing world, the textbook refers to this as audit risk.
Audit risk. Okay.
Audit risk is essentially the professional nightmare scenario for any auditor. It's formally defined as the risk that the auditor expresses an inappropriate audit opinion when the financial statements are, in fact, materially misstated.
Okay, pause right there, because materially misstated sounds like very polite corporate jargon. Let's translate that for you and me. When they say materially misstated, are we talking about someone accidentally forgetting to carry a 1 in a spreadsheet? Or are we talking about something bigger?
It's an important distinction. A misstatement is simply a difference between what is reported and what should be reported according to the rules.
All right.
It could be a simple mistake or it could be intentional fraud. But the key word is material. Materiality means that the error or the lie is big enough that it would actually change the economic decision of someone looking at those financial statements.
Change their decision. Okay.
Yeah. If a multi-billion-dollar tech giant accidentally miscategorizes a $500 office chair, that is a misstatement, but it is not material. Nobody's going to sell their stock over a chair.
Yeah, that makes sense.
But if they invent $50 million in fake revenue to hit their quarterly targets, that is a material misstatement.
A massive one.
Exactly. So audit risk is the terrifying scenario where the company's books are fundamentally massively wrong, perhaps even entirely fraudulent. But the auditor completely misses it, signs off, and tells the public everything looks perfectly fine.
Wow. And the textbook breaks this nightmare down into a very specific mathematical formula. It says audit risk, let's call it AR, equals the risk of material misstatement, or RMM, multiplied by detection risk, DIR.
AR equals RMM times DR.
Right. Why do they split it up like that?
They split it up because it perfectly isolates who is responsible for what. Let's look at the first half of the equation, the risk of material misstatement, or RMM. The critical thing to understand here is that this risk exists entirely independently of the auditor.
Independently, so before they even show up.
Yes, it is present before the auditor even wakes up in the morning or walks through the front door of the company. The RMM is the anticipated risk that a massive error already exists in the financial statements. And the text divides this pre-existing mess into two subcomponents, inherent risk and control risk.
Okay, so RMM is basically what kind of fire am I walking into? Let's look at the first piece of that fire inherent risk. If I'm understanding the text correctly, this is the natural built-in danger of a company's financial claims being wrong, assuming the company has absolutely zero internal safety nets.
Yes. Like if they were just operating on pure vibes with no double-checking.
That is a remarkably accurate way to put it. It is the natural susceptibility of assertion to be materially misstated. And this varies wildly depending on the industry and the complexity of the business.
Makes sense.
The text gives some great specific examples of this. For instance, if a company relies on incredibly complex mathematical calculations to value their assets, say a bank valuing highly exotic derivative contracts tied to future weather patterns, there is a massive inherent risk simply because the math is phenomenally difficult.
Right, it's not that they're necessarily lying, it's just that it's really easy to mess up.
Exactly.
The text also mentions high-value inventory. If you're a company warehousing millions of dollars in loose diamonds or cutting-edge microchips, your inherent risk of that inventory simply vanishing or being miscounted is way higher than a company that warehouses, say, gravel.
Absolutely. Another fascinating example from the text regarding inherent risk involves rapid technological developments.
Oh, yeah. Imagine a company manufacturing a specific type of high-end smartphone. They have warehouses full of them, valued at $100 million on their books.
Okay.
But if a competitor suddenly announces a revolutionary new technology that makes those smartphones obsolete overnight, the first company's inventory might instantly become worthless.
Wow, yeah.
That creates a massive inherent risk that their inventory is suddenly financially overstated on the books simply because the nature of their industry is volatile. The business objectives, the regulatory environment, the complexity of operations, all of these dictate the inherent risk. It's a baseline danger level of the environment.
But companies aren't just sitting there defenseless, letting the environment batter them. They try to build safety nets. And that brings us to the second part of RMM control risk.
Yes, the controls.
This is the risk that the company's internal control systems, their checks, their balances, their security cameras, their software passwords, will fail to prevent or fail to detect and correct a material misstatement on a timely basis.
And here is a foundational rule from the text that applies beautifully to business management in general. Some control risk will always exist.
Always.
Always. It is a fundamental law of organizational design. You can never reduce control risk to absolute zero. No system is perfect because systems are built and operated by human beings.
Okay, so inherent risk, the natural danger multiplied by control risk, the chance safety nets fail, gives us the overall risk of material misstatement. That is the mess that exists before the auditor arrives. Now, what about the auditor side of the equation? Because they are the ones signing their name to this. That is detection risk.
Detection risk is the risk that the procedures performed by the auditor will not detect a misstatement that exists and could be material. This is where the auditor messes up.
It's their own failure rate.
Exactly. They might select an inappropriate audit procedure for the situation, they might misapply a perfectly good procedure, or they might just completely misinterpret the results they're looking at because they're tired or inexperienced.
And this is where the mathematical relationship becomes crucial. The text emphasizes that there is an inverse relationship between the risk of material misstatement and detection risk. How does that play out in the real world?
It is all about maintaining a balance. The auditor has an acceptable overall target for audit risk. They want to keep the chance of making a catastrophic mistake very, very low.
Right.
Now, since they cannot change the risk of material misstatement, because remember that is generated entirely by the company's environment and the company's internal systems, they must adjust their own behavior to balance the equation.
Okay.
If the auditor assesses the RMM as very high, say it's a volatile tech startup with terrible accounting software, The auditor must push their own detection risk extremely low.
Meaning they can't afford to be sloppy. They have to work twice as hard.
Precisely. To drive detection risk down, they have to expand their testing, pull much larger sample sizes of documents, assign their most senior experts to the job, and gather much more rigorous external evidence.
And if it's the opposite?
Conversely, if they're auditing a stable, 100-year-old utility company with brilliant watertight internal systems where the RMM is very low, the auditor can accept a slightly higher detection risk and perhaps do a bit less exhaustive manual testing while still keeping the overall audit risk at a safe level.
Okay, this is a lot of conceptual math. We have the three vital components making up this overall equation of disaster inherent risk, control risk, and detection risk. I'm looking at this list, and I know if I try to recall this tomorrow, I'm going to blank.
It's dense.
So it's time for our very first custom memory technique. We need a way to lock these three words, inherent control detection, into your mind forever. I was thinking about this, and I want you to imagine a beautifully absurd, chaotic scene. The phrase I want you to burn into your memory is ice cream dreams.
Ice cream dreams.
Yeah.
Let's analyze why that specific phrase is highly effective for cognitive retention. We are encoding inherent control and detection.
Think of it like this. ICE stands for inherent risk. It's the natural state of things, the cold, hard, slippery environment the company operates in. If you are walking on ice, there is an inherent risk you are going to fall.
Okay, I see that.
CREAM stands for control risk. It's the smooth, protective layer the company tries to spread over the ice to manage it, to make it safer, their internal controls. Together, the ice and the cream make up the company's internal environment, the RMM.
The pre-existing conditions.
Right. Finally, dreams represents detection risk. That is the auditor. Picture the auditor sleeping on the job, dreaming away, hoping they miraculously detect the issues in their sleep, but potentially missing them entirely because they aren't paying attention. Ice cream dreams.
Yep.
Inherent. Control. Detection.
It creates a very neat structural cognitive divide. The physical elements of the image, the ice and the cream, belong to the company's reality. The conceptual hazy element, the dream, belongs to the auditor's perception and testing.
Yes.
By visualizing a professional auditor in a suit, asleep at their desk, dreaming about a giant bowl of ice cream slipping all over the place, you instantly retrieve the three core pillars of audit risk.
Ice cream dreams. Use it the next time you are evaluating a project at work. Ask yourself, what's the ice? What's the natural risk here? What's the cream? What controls have we put in place? And what are the dreams? How might we completely fail to detect an error?
That's a great practical application.
Okay, so the auditor knows the risks, but what exactly are they trying to prove when they do all this work? What is a company actually claiming when they hand over a massive glossy booklet of financial statements to the public?
That is the core of the profession. When a company presents financial statements, they aren't just giving you a random collection of numbers. They are making a series of very specific implicit and explicit claims about what those numbers represent.
Claims.
Right. In the textbook, and across all international standards on auditing, which you'll often see abbreviated as SA, these claims are referred to as assertions. And the SA rules require auditors to assess the risk of material misstatement at two distinct levels.
Which are?
The first is the overall financial statement level, which refers to massive, pervasive risks that affect many different areas at once, like a corrupt management team that lies about everything. The second is the assertion level, which is much more granular. It's looking at specific line items.
Right, and at this granular assertion level, the text divides the world of accounting into two main categories: classes of transactions and account balances. What is the difference between the two?
It is the fundamental difference between watching a video and looking at a photograph.
Oh, I like that.
It's flow versus snapshot. Classes of transactions cover the flow of economic events over a period of time. For example, all the individual sales a company made throughout the entire 12 months of the year. You are looking at movement. Exactly. Account balances, on the other hand, are a snapshot at a very specific frozen point in time. For example, the exact amount of cash sitting in the corporate bank account at precisely 11:59 BPM on December 31st. Because movement and stillness are different, you have to evaluate the flow very differently from how you evaluate the snapshot.
Which means, of course, the textbook gives us two completely different, highly technical lists of assertions to memorize. Let's start with the video, the flow, the classes of transactions. The textbook outlines 5 specific assertions that auditors have to test for when looking at the flow of transactions over a period. Hit me with the list.
The 5 assertions for classes of transactions are occurrence, completeness, accuracy, cutoff, and classification.
Okay, whoa. That is a wall of abstract nouns. Let me process that. Occurrence, completeness, accuracy, OC, A, cutoff. C, classification. C, OC, CAC. That's not a word, that's terrible. We absolutely need a mnemonic for this, but before we build one, we need to know what these words actually mean in plain English. Let's ground them. Start with occurrence.
Occurrence means the transaction actually happened, and it legitimately pertains to the entity. Let's use a real-world context. If a company records a massive $10 million sale on their books, the occurrence assertion is the auditor asking, did a customer actually agree to buy this product and did you actually deliver it? Or are you just inventing fake sales out of thin air to make your revenue look better for Wall Street?
So, occurrence is checking if it's real. What about completeness?
Completeness is the exact flip side. It asks, have all the transactions that should have been recorded actually been included? Did you leave anything out?
Like hiding bad news.
Yes. For instance, maybe the company have a massive legal expense they had to pay,
Right.
but they deliberately didn't record it because it would ruin their profit margins. That violates completeness.
Got it. Real versus missing. Accuracy seems self-explanatory. Did you do the math right? Did you multiply the quantity by the price correctly? And classification means the transaction was recorded in the proper account category. You didn't record a routine monthly phone bill as a long-term capital asset to make your expenses look lower.
That's correct.
But the last one, cutoff. The text highlights this, and I know from reading financial news that this is a major focus for auditors. Why is cutoff so important?
Oh, cutoff is critical. It asserts that transactions and events have been recorded in the correct accounting period.
Yeah.
I get quite animated about this because historically, so much massive financial manipulation hides right here in the timeline.
In the timeline, how?
Let's look at a hypothetical scenario. Imagine a regional sales director who is absolutely desperate to hit their year-end targets to trigger a massive personal bonus. It is December 28th, the year closes on the 31st, and they are short by $1 million. They have a huge contract signed, but the product isn't scheduled to be manufactured, shipped, and delivered until January 15th of the next year.
Ah, they see where this is going.
Exactly. Under accounting rules, that sale belongs in next year's flow, but the director, desperate for the bonus, illegally records the sale in December of the current year. That is a cutoff error. They are manipulating the timeline, pulling future revenue into the present to create the illusion of current success. It's a very common form of fraud.
That makes total sense. So if I'm doing my own personal budget and I buy a new TV on my credit card on January 30th, but I don't record the expense in my spreadsheet until February because I want my January budget to look responsible, I'm committing a cutoff violation against myself.
Precisely. You're violating the cutoff assertion.
Okay, I understand the concepts. Now let's wire them into your brain. We need to remember occurrence, completeness, accuracy, cutoff, and classification. Let's take those starting letters, O, C, 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 A. Think about a chaotic scene on a street. The phrase to lock in is, only crazy cats chase autos.
Let's map that out. Only stands for occurrence. Crazy stands for completeness. Cat stands for classification. Chase stands for cutoff. And auto stands for accuracy.
Just picture a street full of wildly unhinged felines sprinting after speeding cars. Only crazy cats chase autos. Whenever you are looking at the flow of anything, whether it's your own monthly bank statement or a corporate income statement, ask yourself, are these transactions real? That's occurrence. Is every single one here? Completeness. Are they categorized in the right buckets? Classification. Did they happen in the right month? Cutoff. And is the math actually right? Accuracy.
It's an excellent mnemonic for the flow. But what about the snapshot? The account balances at the period end. We are talking about things like the total inventory sitting in the warehouse, the total cash in the bank, or the total debt owed to suppliers at that exact moment on December 31st.
The frozen moment.
Yes. The textbook provides 4 key assertions for these balances. They are existence, rights and obligations, completeness, and valuation and allocation.
Okay, existence, rights, completeness, valuation, ERCV. We need another image. Let's stick with the animal theme for consistency. For the snapshot, the balances, I want you to picture this. Elephants read comic volumes.
Elephants read colic volumes. Let's break down the mapping. Elephant stands for existence. Does the asset, liability, or equity interest physically or legally exist at the period end?
Okay.
Read stands for rights and obligations. Comic is for completeness. Again, is everything included? And volumes is for valuation and allocation. Is it recorded at the appropriate monetary amount?
I want to dig into that second one, rights and obligations, because the distinction between that and existence feels very tricky to me. If something exists, don't you automatically have the rights to it?
It is a critical nuance, and conflating the two has led to massive audit failures. Let's use your elephant's imagery. Imagine a company's balance sheet claims they own a massive warehouse full of highly valuable, heavy machinery. The auditor walks into the warehouse, physically sees the machines, touches them, and counts them. The existence assertion is perfectly satisfied. The stuff is unequivocally physically there.
Right. Check the box. It exists.
But wait, what if that machinery is being held on consignment? Or what if the company is just leasing it? Or what if they actually sold it yesterday, but haven't shipped it out yet?
Oh, they don't own it.
Exactly.
Uh,
The company doesn't actually own it. They do not hold the legal title. If the company includes that machinery as an asset on their own balance sheet to look wealthier to banks, they have blatantly violated the rights and obligations assertion. They do not hold the rights to those economic benefits. You can have physical existence without having legal rights.
That is such a crucial distinction. Just because a friend parked their Ferrari in your garage doesn't mean you get to put the Ferrari on your personal net worth statement.
That's a perfect analogy.
So if you are analyzing any snapshot of wealth, a balance sheet, think elephants read comic volumes. Existence, rights, completeness, valuation. Are the numbers real? Do they actually own the rights to them? Is every piece of debt included? And is the dollar value assigned to them realistic?
This is exactly why I love these frameworks. They force a highly disciplined, multidimensional approach to truth-seeking. You don't just ask the amateur question, is this number right? You ask specific, targeted questions about the nature of the number.
So what does this all mean? We know the risks. We have the equation of disaster. We know what claims the company is making through these assertions. Now we need to look at how companies actually try to protect themselves from all this risk. So let's talk about guarding the fort. We are talking about internal controls.
The textbook relies heavily on the official definition from SA 315, again, Standard on Auditing 315 for Internal Control. It formally defines it as a process designed, implemented, and maintained by those charged with governance, management, and other personnel to provide reasonable assurance regarding the achievement of objectives relating to the reliability of financial reporting, the effectiveness and efficiency of operations, and compliance with applicable laws and regulations.
Okay, that is a spectacularly dense academic wall of text. Let's translate that into plain English. Those charged with governance is just a fancy way of saying the board of directors, right? The people at the very top.
Yes, the board of directors or an audit committee. The ultimate oversight.
So stripping away the jargon, SA 315 is basically saying internal control is the entire system of rules, physical barriers, and software checkpoints that the board and management build to make sure the company doesn't lose all its money, doesn't break the law, and doesn't lie on its tax returns.
Precisely. It encompasses absolutely everything from the physical padlock on the warehouse door to the mandatory background checks on new hires to the complex software algorithms that automatically match purchase orders to shipping invoices before a check is cut.
But here is where we must play devil's advocate. Why isn't internal control ever 100% foolproof? Notice the SA 315 definition specifically uses the phrase reasonable assurance. Why does the text insist that only reasonable assurance is possible and that absolute assurance is a myth?
Because of the inherent limitations we touched on earlier. What are those limitations?
The text gives a fantastic list. First, there is management's consideration of cost effectiveness. A company is simply not going to spend $1 million on a biometric laser grid security system to protect a warehouse that only holds $10,000 worth of printer paper. It doesn't make economic sense, so they accept a certain level of vulnerability.
Right, it's a cost-benefit analysis.
Second, controls are usually designed for routine, day-to-day transactions. So when a massive, highly unusual transaction happens once a decade, it can easily slip through the cracks because the system wasn't built for it.
That happens quite often in mergers and acquisitions.
And third, basic human error. Misunderstanding instructions, fatigue, clicking the wrong button, or just being distracted. But the really big ones, the ones that cause the massive corporate collapses you read about in the news, are abuse of authority and collusion.
Collusion is the auditor's true, enduring nemesis. Internal controls rely heavily on a concept called the segregation of duties. You never want one person to have total control over a process. The classic example of this is the maker-checker system. Let's look at how it works in theory and how it fails in practice. Imagine employee A is authorized to write a check to a vendor, but they cannot send it. Employee B must review the invoice, approve it, and co-sign the check. This is a perfectly designed control on paper.
Right. Employee A can't steal because employee B is watching them.
Exactly. However, if employee A and employee B decide to team up, if they collude, they can entirely seamlessly bypass this system. Employee A sets up a fraudulent shell company. They write a fake invoice and write a massive check to the shell company. Employee B, knowing exactly what is happening, happily approves the invoice and signs the check. They split the stolen money later. No system of internal control, no matter how flawlessly designed on paper or how expensive the software is, can automatically detect two trusted individuals secretly deciding to work together to commit fraud. The system just sees two authorized users doing their jobs.
That is terrifying, which means auditors can't just look at a flowchart of the company's rules and assume they are working. They need rigorous tools to poke and prod the system to evaluate just how strong or weak these controls actually are in reality.
They absolutely do.
The text outlines 4 specific methods or tools that auditors use to document and evaluate a company's internal controls. And of course, because we have another list of 4, we need another mnemonic. I want you to remember this bizarre image. Mnemonic memory hack: never catch itchy fleas.
Never catch itchy fleas. A visceral image. Let's map it to the 4 tools. Never stands for narrative record. Catch stands for checklist. Itchy stands for internal control questionnaire, which is widely known by its acronym ICQ. And fleas stands for flowchart.
Let me write that out. Narrative, checklist, ICQ, flowchart. Never catch itchy fleas. Now, narrative and flowchart are pretty straightforward. The auditor either writes out a massive Word document describing the process, or they draw a visual map with boxes and arrows showing how a document moves from one desk to another.
Correct.
But the text makes a very specific procedural distinction between a checklist and an ICQ that I thought was fascinating. They sound like the exact same thing to me. Aren't they both just lists of questions?
They do sound similar, but it is a vital procedural difference based on who is actually holding the pen. A checklist contains a series of instructions or questions that are answered by the auditor's own staff. It is an internal document for the audit team.
Oh, internal to the auditors.
Yes. It's a reminder for a junior auditor to make sure they did their job. For example, you'll have a box that says, "Did we verify that the cashier does not have access to the main accounting ledger?" The auditor checks yes after they do the work.
Ah, okay. It's a to-do list for the auditor, but the internal control questionnaire, the ICQ, is totally different. The text says this is a massive, comprehensive list of questions that is physically handed to the company's executives and employees for them to fill out themselves.
Exactly. The auditor gives the company the test to take. And the ICQ is meticulously designed. A broad general question is broken down into numerous highly specific sub-questions that require a simple yes, no, or not applicable answer from the management. And the brilliant psychological trick of the ICQ design is that the questions are specifically framed such that a no answer generally indicates a weakness in the control system.
Give me an example of how that psychological trick works.
Sure. Instead of asking an open-ended question like, how do you handle payroll? The ICQ will ask, are payroll checks distributed by someone other than the person who prepares the payroll? If the manager checks yes, the control is strong. If the manager checks no, they have just explicitly documented their own systemic flaw. It forces management to put their vulnerabilities in writing.
I love the psychology of that. You hand them the rope. Never catch itchy fleas. Narrative, checklist, ICQ, flowchart. But when auditors are looking at these controls today, they aren't just looking at paper checks. They are heavily focused on the company's IT and information systems. The textbook takes time to break down an information system into 5 core elements.
Yes, and understanding these 5 elements is absolutely crucial because when non-technical managers assess their own IT security, they almost exclusively look at one thing: the software. They think if they buy the most expensive enterprise-grade accounting program with military-grade encryption, their system is inherently secure. The textbook frameworks prove this is a dangerously reductive way to think.
Okay, I have a mnemonic for these 5 elements of an information system. Imagine a farm during a hurricane. The phrase is, pigs play during intense storms.
Pigs play during intense storms. Let's line that with the text's 5 elements. Pigs stands for people. Play stands for procedures. During stands for data. Intense stands for infrastructure. And storms stands for software.
Pigs play during intense storms. People, procedures, data, infrastructure, software.
If we connect this directly to the listener, when you are assessing the systems in your own career or evaluating the security of your own personal data, remember this 5-part list. The software you use might be impenetrable, And the physical infrastructure, the servers sitting in an Amazon data center, might be locked in a subterranean vault.
Right.
But what about the people and the procedures? The most devastating corporate cyber attacks and financial hacks don't happen because a criminal mastermind used brute force to break the encryption algorithm. They happen because a stressed person in the accounting department was tricked by a phishing email into handing over their password because the company's procedure for verifying password resets was weak. The vulnerability almost always lies where the messy people interact with the rigid procedures, not in the software itself.
Such a great takeaway. Think about your own life. You might have a great password manager. That's software. But if your procedure is to leave your laptop open at a coffee shop, people and procedures, your system is broken. Moving on to the next major concept, the frameworks of trust. We've talked about what internal controls are, but how do giant global corporations standardize them? If you have operations in 50 countries, you can't just wing it.
You really can't.
The text throws a veritable alphabet soup of international frameworks at us that companies use to build these systems.
It does, and it's important to understand the historical context of why this alphabet soup exists. As businesses grew into massive multinational conglomerates in the late 20th and early 21st centuries, they needed standardized, universally recognized ways to prove to global investors and government regulators that their internal controls weren't just made up on the fly.
Right.
This led to the creation of several recognized frameworks by various professional bodies. The textbook specifically details CO2, COCO, and COBIT, among others.
Let's focus deeply on the COCO framework, because the textbook breaks down its specific structure into incredible detail, and it gives us an incredibly satisfying framework to memorize. The COCO framework comprises 20 criteria, and these are grouped into 4 specific areas. I want to give you the memory hack for these 4 areas first. Mnemonic memory hack: penguins can catch mackerel.
Penguins can catch mackerel. Let's decipher that. Penguin stands for purpose. Can stands for commitment. Catch stands for capability. And mackerel stands for monitoring and learning.
Purpose, commitment, capability, monitoring, and learning. But what makes COCO unique? Why focus on this one compared to something like COCO SO?
What's fascinating here is the underlying philosophical approach of the COCO framework. While other frameworks often start from a very top-down, structural, almost bureaucratic perspective, focusing heavily on broad corporate environments and rigid rules, the COCO framework is noted in the text as beginning on a much more individual human level.
Human level.
It starts with the employee. Look at the words commitment and capability. It asks fundamentally human questions. Do the individuals in this organization have the ethical commitment to do the right thing? And do they have the actual skills, the training, and the knowledge, the capability necessary to perform their jobs effectively? It recognizes that an organization is only as strong as the psychological and professional reality of the individuals executing the processes.
That feels incredibly modern and relevant, actually. You can have all the rules you want, but if your people aren't committed or capable, the system fails. Let's briefly touch on a couple of the other massive frameworks mentioned in the text. There is COBIT, which stands for Control Objectives for Information and Related Technology. The text notes it has 34 high-level processes and 210 control objectives across 4 domains. It sounds like the absolute gold standard for IT governance.
It is widely used for IT, yes.
And then there is the Turnbull Report, which emphasizes that a company's board of directors must conduct at least an annual review of the effectiveness of the group's system of internal control.
If we connect this to the bigger picture, why do we even care about these massive frameworks? All of these frameworks, from COCO to COBIT, gain massive global prominence because of historical corporate disasters. When companies like Enron and WorldCom spectacularly collapsed in the early 2000s due to breathtaking systemic accounting fraud, it wiped out billions of dollars in shareholder value and destroyed pensions.
Yeah, those are massive shocks.
This led to severe, sweeping legislative responses. The most notable is the Sarbanes-Oxley Act in the United States, specifically SOX Section 404, which the text covers. SOX 404 legally mandates that publicly traded companies must formally document, rigorously test, and maintain their internal controls, and management must legally assess their effectiveness annually. These frameworks are the exact blueprints companies use to comply with the law and avoid their executives going to federal prison.
High stakes indeed. Okay, we know the frameworks, we know the risks, we know the assertions. Now let's get into the doldrums. How does the auditor actually gather the proof to support their opinion? Welcome to the Auditor's Toolkit. The textbook points us to SA 500, the foundational standard on audit evidence.
SA 500 lays down the golden, unbreakable rule of auditing. The auditor must obtain audit evidence that meets two very strict simultaneous criteria. It must be sufficient and it must be appropriate.
Okay, let's define those terms clearly because they aren't just synonyms for good evidence. They mean very different things. Let's start with sufficient.
Sufficient refers strictly to the measure of quantity of the evidence. Do you have enough of it? Did you test a large enough sample size of transactions to confidently say the whole population is fine? If a company has 1 million sales invoices, looking at 3 of them is not sufficient quantity.
Right, that's just a drop in the bucket, but appropriate is different.
Yes. Appropriate refers to the measure of quality, relevance, and reliability of the evidence. You could have a warehouse full of documents, meaning you have a sufficient quantity. But if they're all easily forged photocopies provided by a suspicious manager, they are not appropriate quality. You need original documents, or better yet, evidence from independent third parties.
The quantity and the quality. And the text provides a fantastic, realistic scenario. What happens when evidence is inconsistent? What if the charismatic sales director hands you a beautifully signed document claiming $1 million in revenue, but when you go down to the shipping department, their gritty, handwritten logbooks show only half of that product actually left the warehouse?
The standard requires the auditor to immediately hit the brakes. You must investigate the inconsistency, modify your audit procedures, and determine what additional steps are needed to resolve the doubt. You cannot simply ignore conflicting evidence, average the two numbers, or just believe the executive because they wear a nicer suit.
And sometimes the evidence required is so highly specialized that the auditor, who is an accounting expert, is completely out of their depth. The text gives the example of a company using an actuary to value complex employee gratuity liabilities, or perhaps an engineer to value a newly discovered specialized oil reserve. The text calls this using a management's expert.
And this is a massive area of risk for an auditor. The auditor's duty here under the SA rules is very clear. You cannot simply take the expert's highly technical report, shrug your shoulders, and say, well, they have a PhD in petroleum engineering, so it must be right. The auditor must evaluate the expert's competence, their professional capabilities, and crucially, their objectivity.
Like, do they have a bias?
Exactly. Do they have a financial stake in making the oil reserve look bigger? Furthermore, the auditor must check the relevance and mathematical accuracy of the source data the expert used.
Give me an example of how that goes wrong.
Think about the actuary valuing employee pension liabilities. If the company's management secretly fed the actuary manipulated employee data, say, they lied and said the average age of their workforce was 30 instead of 50, the actuary's brilliant, flawless mathematical formulas will still produce a fundamentally wrong conclusion. Garbage in, garbage out. The auditor has to verify the raw data going into the expert's model, not just the report coming out.
I love how professional skepticism is baked into every single rule. Let's look at another highly specific rule from the text, SA 501, which deals with specific considerations for selected items. Specifically, it tackles the legendary inventory problem.
Inventory. Historically, inventory is one of the absolute easiest places to hide massive financial fraud. It's physical, it's messy, and it's hard to count. Therefore, SA 501 mandates a very strict rule. If inventory is material to the financial statements, the auditor must attend the physical inventory counting. You cannot just take management's word for it. You have to physically go to the warehouse, put on a hard hat, and watch them count the boxes.
Which leads to some amazing real-world stories. I've heard of auditors having to climb literal mountains of agricultural manure to measure the volume, or flying in helicopters over timber forests to estimate the number of trees. You have to be there. But the text presents a fascinating, tricky edge case. What if attendance is legally or physically impracticable? And to be clear, the text doesn't mean it's inconvenient because it's raining or the warehouse is really far away. They mean extreme scenarios, like a massive violent local protest blockading the manufacturing plant, or unforeseen geopolitical events making travel to that country literally impossible.
What does the auditor do then? Do they just skip it and write a note?
Absolutely not. You cannot omit a mandatory audit procedure just because of difficulty, time, or cost if there is no alternative. If attendance is truly objectively impracticable, the standard requires the auditor to observe some physical counts on an alternative date. But more importantly, and this is where the real work happens, they must perform rigorous audit procedures on the intervening transactions.
Break that down. What does that actually mean for the auditor's workload? Let's say the financial year ends on December 31st. But because of a massive blizzard, the auditor can't physically get to the warehouse to count the inventory until January 31st. They go in on January 31st and count 100 boxes. But the balance sheet needs to know how many boxes were there a month ago on December 31st. So the auditor has to perform forensic rollback auditing. Fallback. They have to audit every single shipping receipt for boxes that left the warehouse in January and every single receiving report for boxes that arrived in January to mathematically roll the physical count backward in time to arrive at the precise December 31st number. It is a massive, highly complex amount of detective work.
Which is exactly why auditors will move heaven and earth to not miss the original count. Okay, let's transition to the next phase of evidence gathering. Sometimes, the best way to know if a company's internal numbers are real is to completely bypass the company and ask someone entirely on the outside. That brings us to SA 505 external confirmations.
This is an incredibly powerful tool. Instead of trusting the company's internal ledger that says customer X owes them $50,000, the auditor sends a formal letter directly to customer X asking, "According to our records, you owe this company $50,000. Is this true?" It completely cuts management out of the verification loop.
And the text breaks this down into two very distinct types of requests: positive and negative confirmations. A positive confirmation asks the third party to reply to the auditor in all cases. The letter essentially says, please write back and tell us if you agree with this number or if you disagree with this number. You are demanding an active response. But a negative confirmation is much weaker. It only asks them to reply if they disagree. If this number is wrong, let us know. If it's right, just ignore this letter.
And because of basic human nature, a lack of response to a negative confirmation provides significantly less reliable evidence. People throw mail away, spam filters catch emails, or people are just lazy. Therefore, the text states a very strict rule. Negative confirmations can only be used as the sole substantive procedure if a highly specific set of criteria are met.
Wait, pause right there. Define substantive procedure for us.
Good catch. A substantive procedure is an audit test designed specifically to detect material misstatements at the assertion level. It's the heavy lifting. It's looking at the actual dollars and cents of a transaction rather than just checking if the internal controls, the rules, are working. So the text is saying you can only rely purely on negative confirmations for your heavy lifting if the environment is extremely safe.
Got it. And what are those criteria for it being safe?
The assessed risk of material misstatement must be inherently low. The internal controls over that area must be tested and proven effective. The population being tested must consist of a massive number of very small, homogeneous balances, and a very low exception rate must be expected.
In plain English, you only use negative confirmations for things like routine $50 monthly utility bills for 100,000 residential customers. You assume if the bill was wrong, the customer would yell about it. You absolutely do not use a negative confirmation for the single, massive $10 million contract with a primary supplier. For that, you need a positive, active confirmation.
Exactly.
But here's where the friction happens. What happens if management actively tries to stop the auditor? What if the CEO pulls the auditor aside and says, listen, do not send a confirmation letter to that specific massive client. They get annoyed easily, and it will ruin our delicate business relationship. Just trust our internal paperwork.
If I'm the auditor, my alarm bells should be deafening. They should be. The text requires the auditor to formally inquire as to the management's reasons for the refusal and to seek evidence as to their validity. But more importantly, the auditor must immediately evaluate the implications for fraud. Why is management so desperate to keep the auditor away from this specific third party? It almost always implies a phantom relationship, a fabricated balance, or a side agreement they don't want you to see.
Here's where it gets really interesting. Because the ultimate red flag in auditing often involves exactly who the company is doing business with. Let's talk about related parties, which is covered extensively in SA 550.
Auditors are practically obsessed with related parties. A related party is an entity or a person that has common control, joint control, or significant influence over the company being audited. Think of a CEO who manages the public company, but who also personally owns the private logistics company that ships all the public company's products.
And why is that such a massive problem? Because it is the absolute easiest, most direct way to siphon money out of a company or manipulate earnings. Let's walk through a step-by-step hypothetical scenario to show how this works. Let's say I'm a corrupt CEO of a public company. I set up a private shell company in my spouse's name. Then I have my public company buy all its raw materials from my spouse's shell company at triple the actual market price. The public company's shareholders lose money because expenses are too high, but I am personally funneling all that extra corporate cash directly into my own family's bank account.
That is exactly how it happens. To combat this, auditors meticulously scrutinize any transactions with related parties, especially those that appear to be outside the normal course of business. The text provides a chilling list of scenarios that should immediately trigger a full-blown fraud investigation.
Let's go through that list from the text. Number one, transactions with offshore entities in jurisdictions with weak corporate laws. If you are doing business in a tax haven with high secrecy laws, the auditor wants to know why. Number two, leasing premises or rendering management services with absolutely no consideration, meaning doing it for free. Why would a profit-driven company do something for free unless there is a hidden related party relationship pulling the strings? Number three, sales transactions with unusually large discounts or returns. And number four, circular arrangements.
Circular arrangements, also known as round-tripping, are a classic hallmark of complex financial fraud. We saw echoes of this in massive scandals like Wirecard. Here's how it works. Company A sells a digital asset or a consulting service to Company B. Company B then sells it to Company C. Company C then sells it right back to Company A at an inflated price. No actual economic value was ever created, no real product ever reached a consumer, but every single company in the circle gets to record massive revenue on their books for the year. By identifying related parties, auditors can map these hidden networks of influence and expose the manipulation.
It is absolute high-stakes corporate detective work.
All right, we are entering the final phase of the audit journey. The fieldwork is done, the inventory is counted, the evidence is gathered, and the related parties have been mapped. Now comes completion and review. We start with SA 560 subsequent events.
The world doesn't neatly stop on December 31st, but the financial statements do. Subsequent events refer to things that happen between the date of the financial statements and the date the auditor actually signs the final audit report, which might be months later. Give me an example of why that matters.
Imagine a company has a stellar year. The balance sheet on December 31st looks incredibly strong. But on January 15th, their primary manufacturing warehouse burns to the ground, uninsured. The financial statements for the year ending December 31st are technically mathematically accurate as of that day. But releasing those statements to the public in February without mentioning the massive fire would be horribly misleading to investors.
So the auditor has to keep their eyes wide open right up until the literal ink dries on their signature. They have to review board minutes from January and February to see if disaster struck after the bell rang, which ties directly into one of the most existentially terrifying standards for any company, SA 570, going concern.
The going concern assumption is perhaps the most foundational accounting principle. It is the underlying belief that the company will continue to operate for the foreseeable future, which is generally defined as at least the next 12 months. When preparing financial statements, management is explicitly required to assess whether they can actually survive the year.
And if management hasn't done this assessment, the text is crystal clear. The auditor must demand they make it. The auditor needs to look at the hard reality. They review cash flow forecasts. They look at debt maturities. Do they have a massive loan due in June that they can't pay? They look at the potential loss of major customers. Are they going to run out of money, default, and go bankrupt in August?
If the auditor investigates all of this and concludes that a material uncertainty exists regarding the company's ability to continue as a going concern, the reporting requirements are very precise and highly consequential. If management has properly and honestly disclosed this existential threat in the footnotes of the financial statements, the auditor will issue an unmodified or clean opinion on the numbers themselves. However, the auditor is required to add a very prominent, completely separate section to their final report, explicitly titled Material Uncertainty Related to Going Concern.
It's essentially the auditor's way of flashing a giant red neon sign to the investors. It says, the historical numbers from last year are mathematically accurate, but warning, this ship has a massive hole in the hull and might sink before the end of the year. It's devastating for a company's stock price, but essential for public truth. Finally, right before the auditor walks out the door, they execute SA 580 written representations.
This is a formal letter signed by the company's highest management, usually the CEO and CFO. In it, management formally confirms in writing that they have fulfilled their responsibility for preparing the financial statements, that they believe the controls are effective, and that they have provided the auditor with all relevant information and total access.
But the text includes a vital caveat about these written representations that I think perfectly encapsulates the entire psychology of the auditor's mindset.
Yes, the standard explicitly states that while written representations are necessary audit evidence, you have to get the letter, they do not provide sufficient appropriate audit evidence on their own about any of the matters they deal with.
I love that so much. The auditor forces the CEO to sign a legally binding letter saying, I gave you everything and I didn't lie to you. And the auditor takes the letter, files it away in their briefcase, and thinks, great, I still absolutely do not trust you, but I have this on record if we end up in court. It's a complement to the actual gritty auditing work, not a substitute for it. You can't just ask the prime suspect if they committed the crime, get a signed dissentient saying no, and close the case.
It all circles back to the core ethos of professional skepticism. The auditor trusts absolutely nothing that cannot be independently verified, tested, and systematically mapped against the rigorous frameworks we've discussed today.
And what a journey it has been through those frameworks. We have traversed the absolute core of advanced auditing, translating dense essay standards into reality, and relying on some truly bizarre mnemonics to wire it into your brain. I want you, the listener, to take a moment right now and test yourself. See if the cognitive science worked. Do you remember the equation of disaster? It's audit risk equals RMM times detection risk. And what are the three subcomponents?
Think of the image. Ice cream dreams.
Yeah.
Inherent risk, control risk, detection risk.
Yes. And when you are looking at a flow of transactions over time, how do you remember the five assertions? Picture the street. Only crazy cats chase autos. Occurrence, completeness, classification, cutoff, accuracy. And for the snapshot, the balance sheet. Think of the animals reading. Elephants read comic volumes. Existence, rights and obligations, completeness, valuation, and allocation.
And when evaluating the physical tools auditors use to test internal controls, never catch itchy fleas. Narrative record, checklist, ICQ, flowchart, and the five elements of an IT system. Pigs play during intense storms. People, procedures, data, infrastructure, software. Finally, the four areas of the COCO framework criteria penguins can catch mackerel. Purpose, commitment, capability, monitoring, and learning.
We have literally rewired your brain with CA Final Advanced Auditing Standards. But more importantly, I strongly encourage you to use these frameworks in your own daily life. Connect them to your reality. When you are designing a new workflow for your team, think about inherent versus control risk. Where are the natural points of failure, the ice, and what safety nets the cream can you build? When you are evaluating a personal investment, act like an auditor looking at assertions. Does the value actually exist? Do they actually have the legal rights to it, or is it smoke and mirrors?
The value of this material extends far beyond passing a professional exam. The core themes of this auditing textbook, relentless critical thinking, the demand for appropriate and sufficient evidence, and unyielding professional skepticism are essential life skills. In an era where we are constantly bombarded by information overload, deep fakes, misleading statistics, and manipulated data, the ability to systematically question the source, test the controls, and verify the assertions is arguably the most important cognitive tool you can possess. This raises an important question, though, as we look to the future. We have spent this entire deep dive looking at rigorous frameworks designed to evaluate human systems, human errors, and human fraud. But we are standing on the precipice of a massive technological shift.
Oh, I know exactly where you're going with this. As artificial intelligence systems begin to fully automate the generation, categorization, and processing of massive volumes of financial records, how will the audit risk formula adapt? Think about it. If an advanced AI system completely eliminates human error and fatigue in transaction processing, does control risk effectively approach zero?
That is the utopian view. But the dystopian, and perhaps much more realistic view, is that the black box nature of advanced AI introduces a massive, entirely unquantifiable new layer of inherent risk. If the AI is making complex valuation decisions based on deep learning algorithms that even its human creators cannot fully explain or reverse engineer, traditional auditing checklists, our narrative, checklist, ICQ, and flowcharts might become completely useless. You cannot give an internal control questionnaire to a neural network and expect it to honestly document its own systemic flaws.
Exactly. How do you test the commitment and capability, the human elements of the COCO framework of a machine intelligence? You are left to ponder how exactly you would design an audit for an AI. Do we need an entirely new, unrecognizable set of assertions? This fascinating and slightly terrifying frontier. But for today, you are armed with the foundational frameworks of truth. Thank you so much for joining us on this deep dive into the architecture of trust. We will see you next time.